Here's something that should probably bother you more than it does. The billionaires who tell everyone to stay invested in the stock market are quietly moving their own money somewhere else entirely. While average investors follow the standard advice about diversification and compound growth, the ultra-wealthy are loading up on assets that barely get mentioned in mainstream financial coverage. And the timing of these moves tells you everything you need to know about what they expect is coming. After years of studying the gap between what wealthy people say and what they actually do, I'm going to pull back the curtain on exactly what billionaires are buying right now, why their behavior has shifted so dramatically, and what lessons regular people can take from their strategy. This isn't about panic, it's about understanding. Here's what most people don't realize about billionaire portfolios. The advice you hear in interviews and financial columns rarely matches what's actually happening behind the scenes. When Warren Buffett tells viewers to buy index funds and hold for the long term, that's genuinely good advice for most people. But here's the thing that changes everything about how you should interpret that guidance. Buffett himself isn't following it. Neither are most of the ultra-wealthy investors who've built fortunes over the past few decades. Now, I know what you're thinking. This sounds like the beginning of some conspiracy theory about elites manipulating markets. But that's not what's happening here. The moves these investors are making are documented in public filings. Anyone can see them if they know where to look. The real issue is that most people don't look, and the financial media rarely connects the dots. If you examine recent SEC filings and quarterly reports from major wealth managers, a clear pattern emerges. Over the past 2 to 3 years, there's been a significant shift in how the wealthiest investors allocate their capital. We're not talking about minor adjustments or normal rebalancing. We're talking about fundamental changes in what they're willing to own and what they're actively avoiding. Consider Berkshire Hathaway's cash position. As of recent reports, Buffett is sitting on over $150 billion in cash and short-term treasury bills. That's not a typo. $150 billion. This represents one of the largest cash positions the company has ever held as a percentage of its total assets. The question is obvious. Why would one of history's most successful investors be holding this much money on the sidelines? The answer isn't panic or pessimism. What he's doing is positioning for a different scenario than the one most retail investors are betting on. He's maintaining flexibility to act when opportunities arise that aren't available today. And this kind of strategic patience tells you something important about what sophisticated investors see coming. The wealthy understand something that most people miss entirely. It's not about predicting exactly what will happen next month or next year. It's about not being fully exposed to any single outcome. When you have enough money, your primary goal shifts from growth to preservation. You're not trying to double your wealth overnight. You're trying to make sure you still have wealth regardless of which economic scenario plays out. So the question becomes, what exactly are they moving their money into? The first thing you'll notice when you look at where billionaire money is actually flowing is a massive increase in hard assets. We're talking about physical things you can touch. Farmland, commodities, water rights, energy infrastructure. These aren't the kinds of investments that make headlines, but they represent a fundamental shift in how the ultra-wealthy think about preserving capital. Let me give you a concrete example that illustrates this perfectly. Bill Gates is now the largest private owner of farmland in the United States. He owns roughly 270,000 acres across dozens of states. When this news first broke, people made jokes about it on social media. But here's the thing most people missed entirely. Gates isn't buying farmland because he suddenly developed a passion for agriculture. He's buying it because farmland represents something that financial assets don't, a physical resource that produces value regardless of what happens in stock markets or currency systems. Think about what farmland actually is. It's land that grows food. People need food whether the economy is booming or crashing. Whether inflation is at 2% or 12%, crops still grow and people still need to eat. The value of that production doesn't disappear when markets get volatile. And unlike stocks or bonds, you can't print more farmland. The supply is essentially fixed. Now, I know what you're thinking. This sounds like the strategy of someone preparing for the apocalypse. But that's not quite right. What these investors are doing isn't panic buying or doomsday prepping. It's hedging. They're not predicting that civilization will collapse. They're positioning themselves so that if traditional financial assets underperform for an extended period, they still have wealth stored in things that maintain intrinsic value. It's like owning the farm instead of just owning shares in a company that buys food from the farm. Both can be profitable, but one is inherently more resilient to systemic shocks. Historical precedent backs this up. During periods of high inflation or currency instability throughout history, real assets have consistently outperformed paper assets. The wealthy families who survived major economic disruptions often did so by owning tangible resources rather than relying solely on financial instruments. But hard assets are just one piece of the puzzle. The second category might surprise you even more. The second category is where things get really counterintuitive, and it's probably going to challenge what you think you know about smart investing. Billionaires are holding massive amounts of cash, not invested in anything exciting, not deployed into the next big opportunity, just sitting there in treasury bills and money market funds. Now, I know what you're thinking. Why would the smartest investors in the world let their money sit idle when they could be putting it to work? Doesn't holding cash mean you're losing money to inflation? And honestly, that's exactly what conventional financial wisdom would tell you. Cash is supposed to be a drag on your portfolio. But here's the thing that changes everything about how you should think about cash. For the ultra-wealthy, cash isn't a waste. It's a weapon. Warren Buffett has said publicly on multiple occasions that he loves having cash available because it gives him options. When markets crash and everyone else is panicking, cash lets you buy quality assets at distressed prices. It's the dry powder that transforms a crisis from a disaster into an opportunity. The people who made fortunes during the 2008 financial crisis weren't the ones fully invested when everything collapsed. They were the ones who had cash ready to deploy when prices hit rock bottom. Consider what this looks like in practice. Berkshire Hathaway is sitting on over $150 billion in cash and short-term treasuries. That's roughly 30% of their total market value just waiting. From a traditional perspective, this looks inefficient. From a strategic perspective, it's positioning for opportunity. This connects to Buffett's famous advice: be fearful when others are greedy, and greedy when others are fearful. But most people only remember the quote without understanding what it actually requires. To be greedy when others are fearful, you need resources available to act. You can't buy the dip if all your money is already experiencing that same dip. The wealthy understand that liquidity is itself a form of investment. When you hold cash, you're not just holding currency, you're holding optionality. You're buying the right to act decisively when everyone else is frozen with fear. But here's what makes this even more interesting. The third category reveals what billionaires actually expect to happen. The third category is where the overall strategy becomes clear, and it reveals exactly what billionaires are hedging against. They're accumulating alternative stores of value: gold, certain cryptocurrencies, foreign currencies, and international real estate. These are all assets that exist partially or entirely outside the traditional financial system centered on the US dollar. Ray Dalio, founder of the world's largest hedge fund, has been publicly advocating for gold allocation for years. In recent interviews, he's explained his reasoning in remarkably blunt terms. He's not predicting the end of the dollar. What he is saying is that the current monetary system is under more stress than most people realize, and prudent investors should have exposure to assets that don't depend on any single government's promises. Stanley Druckenmiller, another legendary investor with one of the best track records in hedge fund history, has made similar moves. He's talked openly about his concerns regarding fiscal policy and the long-term trajectory of government debt. Here's what's fascinating about this pattern. Not all billionaires agree on which alternative assets are best. Some are skeptical of cryptocurrency and stick purely to gold. Others have embraced Bitcoin as digital gold for the modern era. Some are buying property in Switzerland or Singapore. The specific choices vary based on individual philosophy. But the underlying principle is consistent across almost all of them. They're reducing their total exposure to any single economic system or currency. They're creating portfolios that can survive and even thrive under multiple different scenarios, not just the optimistic baseline that most retail investors are betting on. When you connect all three categories together, a coherent picture emerges. Hard assets provide real-world value that persists regardless of financial market conditions. Cash provides flexibility to act when opportunities arise. Alternative stores of value provide insurance against currency debasement or systemic stress. Together, these three pillars create a portfolio optimized for resilience across a range of possible futures. This isn't about predicting collapse. It's about acknowledging that the future is uncertain and positioning accordingly. Now that we know what they're buying, the real question is why. What do they see coming that the rest of us might be missing? To understand why billionaires are making these moves right now, you have to look at what's actually happening in the broader economy. And honestly, The numbers paint a picture that most people aren't paying attention to because it unfolds slowly rather than in dramatic headlines. Let's start with debt. The United States government currently carries over $34 trillion in national debt. That number is so large it's almost meaningless to most people, so let me put it in context. The debt-to-GDP ratio is now around 120%, meaning the government owes more than the entire economy produces in a year. Here's the thing about government debt that most people don't fully appreciate. Debt isn't just a number on a balance sheet. It comes with interest payments, and as interest rates have risen over the past few years, the cost of servicing that debt has exploded. The federal government now spends more on interest payments than it does on national defense. Let that sink in for a moment. This creates what economists call a fiscal spiral. Higher debt leads to higher interest costs, which leads to larger deficits, which leads to more debt. The math doesn't work forever. At some point, something has to give, whether that's higher taxes, reduced spending, inflation to erode the real value of the debt, or some combination of all three. Now, I know what you're thinking. People have been predicting fiscal disaster for decades, and it hasn't happened yet, and that's a fair point. Economies can carry high debt loads for long periods under the right conditions. But the wealthy understand something that most people miss entirely. It's not about predicting exactly when problems will materialize. It's about recognizing that the range of possible outcomes has widened considerably. The billionaires making these moves aren't prophets with crystal balls. They're probability thinkers who recognize that the distribution of possible futures looks different than it did a decade ago. They'd rather sacrifice some potential returns to reduce their exposure to scenarios that, while not certain, have become meaningfully more likely. This raises an obvious question. What can someone who isn't a billionaire actually do about any of this? Now, I know what you're probably thinking. This is all very interesting for people with private wealth managers and millions of dollars to invest. But what about the rest of us? Most people can't buy 200,000 acres of farmland or sit on $100 billion in cash waiting for the perfect buying opportunity. And honestly, that's a fair point. The specific positions billionaires take aren't directly replicable for someone with a normal income. But here's the thing that changes everything about how you should think about this information. It's not about copying their exact positions. It's about understanding their principles and applying them at whatever scale makes sense for your situation. Let me break this down into 3 principles that anyone can use. The first principle is diversification beyond a single scenario. Most regular investors are essentially making one bet: that the economy will continue growing roughly the way it has, that stocks will keep going up, and that the dollar will remain stable. That's not a crazy bet. Historically, it's been a winning bet more often than not, but it's still just one bet. The wealthy spread their exposure across multiple possible futures. You can do the same thing on a smaller scale. The second principle is maintaining liquidity. You don't need $100 billion to benefit from having dry powder available. Even keeping 3 to 6 months of expenses in an accessible savings account gives you options that most people don't have. When unexpected opportunities arise, or when you need to weather a difficult period, that liquidity becomes incredibly valuable. The third principle is owning real things, not just paper claims on real things. For most people, this might mean I-bonds that protect against inflation, a small allocation to precious metals, or simply paying down mortgage debt to own more of your home outright. These aren't exotic strategies. They're accessible versions of the same thinking. The key insight is that the wealthy aren't smarter than everyone else. They just have systems that protect them from single points of failure. You can apply this same thinking with $50 a month just as effectively as with $50 million. But there's one more piece to this puzzle that most people miss entirely. The biggest mistake people make when they hear about economic uncertainty isn't doing the wrong thing. It's doing nothing at all. They feel overwhelmed by the complexity, paralyzed by the options, and they decide to figure it out later. But later never comes, and meanwhile, they remain fully exposed to exactly the scenario they're worried about. This is the part that most financial advice completely ignores. The psychology matters just as much as the strategy. You can know exactly what you should do and still not do it because the gap between understanding and action feels impossible to cross. Here's the thing about financial transformation that most people don't understand. It doesn't happen through dramatic one-time moves. It happens through boring, consistent, incremental steps that compound over time. The billionaires we've been talking about didn't build their resilient portfolios in a single afternoon. They built them over years and decades, making small adjustments and maintaining discipline through market cycles. This is actually good news for everyone else. It means you don't need to have everything figured out before you start. You don't need to perfectly time the market or make the optimal decision on every allocation choice. You just need to start moving in the right direction and keep moving consistently. Let me show you what this looks like in practice. Imagine two people who both learn about these principles today. Sarah decides to start immediately with whatever she can manage, even if it's just $50 a month into I-bonds and building up her emergency fund. James decides to wait until he has more money, more time, more information. 5 years from now, Sarah has built a foundation of resilience. James is still waiting for the perfect moment that never comes. Studies on behavior and savings consistently show something counterintuitive. People who give themselves permission to start small are far more likely to build sustainable habits than people who wait until they can do it perfectly. The wealthy didn't become wealthy by being brilliant. They became wealthy by being consistent, by making slightly better decisions than average over long periods of time. You have access to exactly the same advantages. So where does all of this leave you? Here's the reality of what we've covered. Billionaires are quietly repositioning their portfolios into hard assets, cash reserves, and alternative stores of value. They're not predicting an imminent collapse or building bunkers. What they're doing is much more rational than that. They're reducing their exposure to any single economic scenario because they understand that the future is genuinely uncertain. The specific assets they're buying, farmland, treasury bills, gold, international real estate, aren't exotic or complicated. They're boring. And honestly, that's kind of the point. These moves aren't about chasing returns or finding the next big thing. They're about building resilience into portfolios that might have to weather conditions very different from the past few decades. You can apply the same principles at whatever scale makes sense for your life. Diversify beyond a single outcome. Maintain some liquidity for opportunities and emergencies. Own real things that hold value regardless of what happens in financial markets. Start where you are, not where you think you should be. The difference between people who build wealth and people who don't isn't intelligence or access to secret information. It's not about having rich parents or getting lucky with a stock pick. It's about consistency and the willingness to act before you have perfect certainty. The person you'll be in 5 or 10 years is shaped by the small decisions you make today, even the ones that feel insignificant in the moment. So there you have it. What billionaires are buying isn't some revolutionary secret that only the ultra-wealthy can access. It's just probability thinking applied with discipline over time, which apparently makes it rarer than a unicorn. The wealthy aren't playing a different game than the rest of us. They're just playing it more consistently, with systems that protect them from the mistakes most people make. Your future self will either thank you for paying attention to this or wonder why you waited so long to start. It's not glamorous, but neither is financial stress. Start with whatever you can manage, be consistent about it, and let time do what it does best.